Hi, I'm Pavithra, and now I'm going to explain about the topic predictive accounting. Under this, we're going to learn about the meaning, the working process, the extension ledger, and the leading ledger are the types of ledger which are created while using the predictive accounting, advantages, and the disadvantages. Meaning, predictive accounting predicts future revenue and cost on the sales processes in the universal journal when a sales order is created before any accounting documents posted from the subsequent processes. Predictive. The word predictive means which we are going to analyze for something which is going to happen in the future. So, predictive accounting means analyzing the future cost, revenue, or the threads, something which the company is going to incur. How it works. So we'll look into the working process of predictive accounting. Here I've taken the example of sales order. When a sales order is created, predictive accounting creates predictive journal entries for the corresponding future goods issue and billing document in a special extension ledger, the prediction ledger. So when a customer makes a sales order, and when the company receives it, so the company prepares some journal entries, and after giving or transporting the sales to the customer, the actual transactions are been recorded. So before that, when the company receives a sales order, the company prepares extension ledger and leading ledger. Using the postings in the prediction ledger along with the actual data from the underlying ledger, you can predict future figures such as the revenue forecast for one product. It is also possible for you to see a report of all items for one product. You can display and analyze the data in detail. So, what is the use of prediction ledger? So, now we have the data of sales order before we have transported the sales, and after we have the data of after transporting the sales order to the customer. So by using these both data we can compare now, so we can identify like what mistakes or in which area we need to develop more. Extension ledger. It contains all journal entries for all business transactions that are posted to it. If companies need additional views of their financial data, for example, for management reporting or tax purposes, they can use the options of extension ledger. Here, extension ledger is also known as delta ledger. In this, only the differences between the valuations are posted, and by using this there are like advantages such as flexibility. We can set up new extension ledgers very easily, and it reduce data footprints, like only the additional transactions are being entered into the extension ledgers. So when a company owner or a person, if he want to see any additional transactions, he can easily open the extension ledgers where all the additional transactions are being entered into it. So it reduces the data footprint which should be recorded in the standard accounting. Leading ledger. So, leading ledger is integrated with all subsidiary ledgers and is updated in all company codes. This means it is automatically assigned to all company codes. In each company code, the leading ledger receives exactly the same settings that apply to that company code currencies. So, here, leading ledger is also known as main book of accounts. Here, the subsidiary ledgers are nothing but the non leading ledgers. The entries which are made in the leading ledgers are all copied to the non-leading ledgers, and then the differences are identified in each books and adjusted in that particular ledgers. Advantages of predictive accounting: forecast upcoming revenue based on sales order, predicted receivables, and profit margin accurately. Based on the predicted revenue and expected expenditures, we can have a report for working capital at a future date. Identifying exception and opportunities, overview of future cash flow, and other similar reports based on predictive data for future periods. So, using the data or the prediction, we can analyze the future revenue, or the loss, the profits, and we can also predict like how much cost is needed for future production of products, and we can identify the threats and opportunities for the company so that the company can be prepared or make some arrangements according to it. And we can also get the figure of the cash flow which the company will need in the future. Disadvantages of predictive accounting: all the sales document categories can't be configured for predictive accounting. Currently, only sales document category for order, credit memo request, debit memo request, return, and order without charge. Service based sales scenarios cannot be reported using predictive accounting. So, the disadvantages of predictive accounting is that it cannot be applied to all types, like it is configured only to some, like sales, finance. And the other disadvantages is that suppose a company is into the service based, and those type of companies cannot use this predictive accounting. So I have come to the end. Thank you.